Welcome to All About Stocks. We've had a continued period of weakness in our markets. Foreign investors are still pulling out money, moving it to greener pastures. At a time like this, it's important for us to re-strategize our portfolios and figure out how it's best to approach these markets. We have a very special guest on the show today who's going to help us find an investment strategy that works for us as retail investors. And before I welcome my guest, let me bring in Ajay for a quick update on how the markets ended the week and for an outlook on how the earnings might look next week.
Thanks for that, Faye. Well, the highlight of the week was that Nifty could not really sustain onto the pullback rally, of which it gained around 130 points and got bogged down by a weak set of earnings as far as Infosys is concerned. During the week, we also saw a lot of macro data coming in, so IIT at minus 0.6, much better than minus 1.2 what the market was actually estimating. Even the CPI inflation, which fell on a month-on-month basis, could not help market regain ground. Infosys was the biggest weight on the market, down almost 23% on weak earnings. Tata Motors on good March sales numbers. Cipla, Lupin on expectations that earnings will be good, really rallied this week. But coming back to Infi, which put up a very bad show, very weak set of guidance of 6 to 10%, and margins being hit by almost 300 basis points, weighed in on the market sentiment. Going forward, TCS, HCL Tech is what the market is watching out for very closely. Much better than what Infosys delivered is the expectation on the market. And again, Reliance Industries would be the large one, what the market would be watching out for closely, where there are expectations that the GRMs would remain around $10. Also, the market, whether it presents an opportunity for a pullback or not, will depend on how TCS and HCL Tech report their numbers. Back to you, Flo.
Hi, Ajay. Thank you for that information. Now, like I said, we have a really important guest this week. Nirmal Jain of India Infoline has been kind enough to take some time out and help us understand what's going on in the market and help us figure out what our investment strategy should be. Nirmal, thank you so much for spending time with us. The Sensex is down 8% since we last spoke in January. It seems like a time when nobody's willing to give us any good news. There's a lot of very pessimistic views coming out about the market. From your point of view personally, how long do you think this is going to go on for? And should we brace ourselves? Is the worst yet to come?
Yeah, I think you're right. It's unfortunate that since we last met and last few months, things haven't gone the way people expected them to be. In fact, a lot of expectations were aroused when new finance minister took charge and he started the process of reforms with great courage and conviction, which was unexpected of coalition government of this type, and also given their track record in the last 3-4 years prior to the September-October when the entire process changed. I think a lot of damage was done earlier, and the government now is trying its best to come out of it and try to set things right. So unfortunately, the problems that remain with the power, ports, roads, infrastructure, and then they have a cascading impact on the entire economy. So we should not forget that supposing the power project is stuck, then it causes a problem for the banking sector. Not only that, it also causes problem for several other dependent industries that have supplied, and also the cost goes up with the capitalization of interest. So I think the macro numbers have worsened, and while the reform process got some momentum and some energy, but it could not be carried to logical conclusion with the large ticket items which are land acquisition, coal mining, and the stalled projects. Unfortunately, government has not been able to get its way there. And also, globally, commodity prices have fallen, and the positive sentiment which was there, a lot of question marks. There are a lot of concerns about China, the way China is going in terms of slowdown, as well as its impact on the commodity prices, and therefore its impact on the global capital flow. So I think these are the medium-term trends, but immediate future doesn't look very bright because whatever news flow we'll see in terms of, say, GDP for last quarter, or even the cement dispatches numbers or auto numbers, they are very dismal. They are looking very bad. So from market point of view, I think one has to be cautious in the near term. But if you're a medium to long-term investor, then I don't think you have anything to worry.
So if you're saying that we should be investing in this market as long-term investors, could you tell us how we should pick the stocks right now? Because it does seem like everything is doing badly. So as a retail investor, how do I pick a stock that seems right?
See, again, in times like these, if you look at sectors, I think we discussed last time also, like IT, pharma, they are doing well. In fact, many of those stocks are done well. So if you look at stocks like Sun Pharma or even Torrent or Cipla looking in pharma sector or certain few good stocks in the IT sector, then I think, so you should invest your equity portfolio. I'm not saying that you be overweight equity in these times, but I think whatever is the equity portfolio, you should be more leaning towards defensive.
You were talking about IT and pharma. I also want to understand from you as far as expectations for next week's earnings are concerned. There is a view that the large cap IT or the large cap banks might disappoint and then we'll see a further cut in these stocks. Is that a view that you share?
I don't really agree with that view. I think that IT sector will be a bit of a mixed bag because some of the companies may pleasantly surprise and some of the companies may give guidance which is better. As far as banks are concerned, I think expectations have already been factored in that there is a problem in terms of NPAs. And I have a feeling that maybe private sector banks will be better off as compared to public sector banks, but still banks, there can be some disappointment. More or less market is already preparing for that.
So while we're talking about banking, before we move on very quickly, are you expecting a rate cut from the RBI in May? Is that something you think we should be factoring in as well?
I think there will be a rate cut, but more rate cut during this year will be more hesitant. It won't be a significant rate cut. So there is a 25 basis point rate cut that we are expecting in the month of May. Unfortunately, what has happened is that whatever rate cut we have seen, they have not been passed on to borrowers.
Like I said the last time while we were talking, you said pharma. We've also seen FMCG become really attractive, especially among retail investors at times like this. Is this, like, should we go back to the defensive at this point if we're picking stocks, right?
So FMCG sector, I think there are signs of slowdown in some segments of FMCG sector. So one will have to be selective about FMCG in terms of valuations as well as which product categories the company is catering to. Pharma, I think names that I suggested earlier also we spoke, Sun Pharma, Torrent, Cipla, these are the good names, Dr. Reddy's, these are the good names, not to stick to. So I think pharma, IT, FMCG, this will still be there. In FMCG again one has to be very selective. Stocks like ITC or stocks like Imami for that matter, and they look good.
So for the
Imami, Pidilite, for the paint stock like Berger Paint or Asian Paint.
For a retail investor watching at home right now, the reflex action would be to pull all of his money out, keep it in cash, or maybe move it into some sort of debt investment. If you were to give an ideal equity to debt breakup right now to someone with a long-term horizon who's possibly investing his retirement money, let's assume, what would that breakup be?
Normally, I think it depends again on the quantum of money because for retirement, there's some safety money that you need that should come from interest income. So whatever you need to make sure that your life is comfortable in retirement. So supposing, I need 50,000 rupees per month. Then maybe 20 lakh rupees or 25 lakh rupees investor will give me that kind of income. So the remaining part of money I can look at investing in equity or equity and real estate and a mix of that. Or very broadly you can put 30 to 40% money in equity and the remaining money will be in debt or other instruments. So that is what the breakup of for a retired person will be, and again within that we already discussed the stock.
Right. I want to go back to your recommendations that you gave us in January. Now, first of all, thank you because in spite of the way the market has moved, these are recommendations that seem to have worked. I'm going to compare them to the Nifty. You gave us HCL Tech that in comparison to the Nifty is up 17% since we talked about it. You gave us Sun Pharma, it's up 13% since we talked about it. ITC is up 1%. ICICI Bank is the only one in that pack that's down 16%. For those of us who bought these recommendations based on what you said, would you like to make some changes right now? And is there something about ICICI Bank that we should understand? Would you like us to stay invested?
I would say that of course out of 4 stocks, some of the large caps we have worked. So that's a good, I think, we can continue the same mix. ICICI Bank is a good long-term stock and all of us know it's a tremendous brand and a solid bank. There are concerns about their international assets at this point in time. So I think if you are holding ICICI Bank and you have some patience, for at least 1 year or 2 years, you should continue to hold on to. But in case, I don't think anything will happen quickly in terms of recovery of fortune. And nor will I advise everything at this point in time. So I think one can continue to hold on and and have a horizon of at least 1 to 2 years.
There's another question that's come in very interestingly for you. Samir Shah has written in. He tells us he's holding TCS. He has 40 shares. He has a 50 to 60% profit, which means that he's a long-term investor. He says he can continue to hold on for 2 or 3 years, but he wants to know if it's a good time now to book profits and re-enter at lower levels, which basically means he wants to time the market. Is that something you'd advise him to do?
I don't think so. TCS is a good stock, and I think you should continue to hold on. And that you got 50-60% return makes you tempted to sell, but more often than not, 3 years later, if you switch, then you'll find that TCS has further given another 50-60% return rather than getting to any other stock. So I think if you have a good portfolio and it's not really overpriced, overvalued, then you should not be in a hurry to business. And in case of TCS, the earnings have also grown. So it's not that your returns are something that should make you scared. That will tumble from here.
All right.
Even when the correction, hold on to it.
Hold on to TCS and don't be tempted right now to time the market. Time for a very quick break. When we come back, we'll discuss Nirmal's mid-cap recommendations. We'll talk about SpiceJet, Jet Airways, Dish TV, and we'll also find out what we should be doing with our BHEL stocks. Welcome back to watching All About Stocks on ET Now. Thank you for staying with us. Nirmal Jain is spending some time with us this week, helping us with our stocks investments. Nirmal, thank you so much for staying with us. Last time we spoke, you broke up large caps and mid caps for us as retail investors. You said not more than 25 or 30% in mid cap stocks. Should we be reducing our mid cap exposure at this point?
I don't think so. If you are already invested, you will stay invested that way. But don't put in fresh money at this point in time. Just wait for the right opportunity. But I think, the mid-caps haven't done well because of the market and the way market has been. And unfortunately, there is no local money that is coming to the market. Whether it's mutual fund, whether it's insurance companies, or even individual investors. So the valuations are becoming attractive. But one should not forget that whenever the market recovers, they are high beta stocks. So they bounce back. They don't give an opportunity to re-enter. So, just hold on to, and equity investing is always never win-win, and you can't really review and update or reshuffle your portfolio every week. So I know that some of the mid-cap might not have done well, but they are fundamentally good companies. If the earnings are rising the way we expected, then just stay on with them and wait for the markets to recover.
So we have noticed there's a pattern that every time the market falls, the mid-cap sector seems to be taking a really large hit. Should there be a difference in the way we pick our mid-cap stocks vis-a-vis the large-cap blue chip? Should we be doing more research? Should we be more careful about our mid-cap stocks?
So the entire pack of mid-cap has been falling. So whatever you do research on, the reality is that the new money that has been coming to the market is FI money. We should understand this psychology. The investors that are there in the market are FIs who are mostly targeting large cap. And because many of them are not India dedicated funds, but many of them are ETFs and large sovereign funds. So this kind of a trend will continue for some time. But what happens is whenever there is a trigger or some event, like supposing an election and people are looking forward to a more stable government, then we'll see a huge rush of money to mid-cap. So now that you are already lost in terms of preferred on a mark-to-market basis, don't panic. So stay invested, wait for the right opportunity. Of course, you have to do research into the large cap or mid-cap. You can't just invest without that. But regardless of a good company or a bad company, mid-cap has been battered, mid-cap has been hit very badly. But that's part of the market. That's how equity investing is.
Let's talk about your mid-cap portfolio that you had recommended to us. Let's compare it to the BSE mid-cap. It's down 14%, the benchmark. You said cement stocks, most of them are down about 1%, which means that we've done a little better. Tea stocks are down 20 to 27%. Dish TV in particular that you had mentioned is down about 15%. Now, if we have a mid-cap stock and it's in line with this drop, should we, like you said, be calm about it? At what point should we panic about our mid-cap stock?
See, if you remember, I spoke about it as a trading opportunity. And I think so, it's not a great long-term story because the commodity play and prices keep moving up and down. Cement actually has been a bit of a surprise because discussions are negative 3% as against expectations of analysts is a positive 4%. But I think from a medium to long-term perspective, still you can hold on to cement. Tea is something that you can just get out of it. Distillery again is a good story, but of course it's down in line with mid-cap indices and it's a larger mid-cap. So that also you can hold on to.
So someone who's looking to put in fresh money right now, would you recommend a Dish TV then? Or do you think we should stay with our large caps for the time being?
I think you can look at mid-cap IT and mid-cap pharma also. Like, and people are probably would classify in those mid-cap category. And then you can also look at oil and gas stocks, which is, say BPCL or Oil India. I don't know whether they will, at current market cap, will be part of mid-cap or large cap, but you can try and put some money into that sector and try and balance it.
We also talked about aviation. You said you were bullish on aviation. You talked about SpiceJet and Jet Airways in particular. They're both down quite drastically. Of course, we saw the Jet Airways deal didn't actually materialize. Now, for our viewers who are holding either SpiceJet or Jet Airways, what would you say about the aviation sector?
I would say reduced. Unfortunately, the aviation sector should have got FDI and these were the plays on that kind of expectation. And again, government policy and many other things, there's an interplay of that. So I would say reduce and just remain lighter. Aviation sector as it is was more like a trading play and not a great long-term opportunity in any case. So I think the earnings for this quarter should be good and there should be an opportunity to exit in case you want to reduce the portfolio.
Well, since we're talking about aviation, Gaurav Sharma has written in. He still has 8,000 shares of Kingfisher Airlines, which he bought at about ₹8.80. He wants to know what he should do with that stock now. Is there hope for Kingfisher Airlines, in your view, for a retail investor? There are several of them that are still holding that stock. What should they do?
It's a difficult one, but I think if I were the investor, I would sell because it's becoming very, messy and messier because it's something which is, there's no clarity on this. And one doesn't know that, because every passing day, the problems are getting compounded and it's becoming lesser and lesser attractive from the buyer's perspective. So I would say at this one, I would exit and just, stay clear of these kind of stocks.
But the other stock that we get a lot of questions about is BHEL. Like Dina from Madurai from Tamil Nadu has written in, he has 150 shares of BHEL which he bought at ₹296. And he's very disappointed because it was a darling. It was a stock that everybody said will do well with the economy. But it's been a while since we saw any sort of positive movement from that stock. What should he and all of the other investors who are holding BHEL do?
See, it's not a great stock to be recommended at this point in time because we know what is happening to infra and capital goods and every other sector. It's a great company. So it's just a question of your patience. If you have 2 years, 3 years, 5 years, then I'm sure that one day this company will come back. But if you don't have patience, then I can't say anything. We will end up sell and get out of it. So this is one company in which nothing will happen in the next 6 months at least. But from a 5-year perspective, it's definitely a great company.
Okay. Dina has also asked about Tata Steel, 100 shares at an average cost of 367. Now this is another stock that a lot of us talked about maybe 2 years ago, and there's a lot of trouble from the European business. But what do you think you should do with Tata Steel?
It's a commodity play. I think you can exit. Tata Steel, our memories are of a blue chip because the regulated era. This was a profitable, consistently growing in a blue chip company. But now, when it's exposed to competition and reforms, it's more like a commodity play, and therefore, at this point in time, I don't think the metal in particular should do well given that China may be slowing down.
Alright, when we come back from this break, Punj, Lloyd and Reliance Infra, what should you be doing with those stocks? Don't go anywhere. Welcome back. You're watching All About Stocks on ET now. Thank you so much for staying with us. Nirmal Jain is still with us, helping us with our stocks investments. Nirmal, we have a question that's come in which is very interesting, which is a question I want to bring up because so many people feel this way right now. R.R. Masani has written in. He tells us he feels retail investors should stay away from the market because of all the money that he has lost. He invested 10 lakh rupees in 2005. His portfolio is now worth 1.5 lakh rupees. He tells us he invested in Reliance Infra, Reliance Capital, Punj Lloyd and Balrampur Chini, and he wants to know what to do now. What would you recommend he does?
So unfortunately, the stocks that you pick up based on chips rather than maybe a typical investor like this, they've got 10 lakhs to invest a lot more money. They do well to invest through mutual funds, so that you have a balanced portfolio and that people who understand the market better, and more importantly, they can track the market. And there's a very good lesson for most of the investors that direct equity investing is not for those who pick up stocks and then they forget about, or they can't do anything because if the price goes down, they can't cut their loss. So either you invest to mutual funds, which are respected, good names, and just stick to that, at least the damage will not be as great as this. And if you have to do direct equity investing, then one, your portfolio should be larger, and two, you should be tracking it on a very continuous basis.
Can you tell us when someone like him picks up a stock, how does he decide what his stop loss should be and at what point he should cut his losses?
So for a trader, stop loss can be 2%, 5% depending on what kind of liquid stock, what is he buying here. But supposing as an investor you're buying and your stock starts falling, I would say that as a rule of thumb, any stock that has fallen by 20%, then there's a serious cause of concern. Some stock that has fallen more than the market, say is falling at a pace double the market, then at least there should be an alert for you that there's something seriously wrong with the stock.
Okay. And there are a lot of questions that have also come in from viewers saying that since the US and the Japanese market are doing so well in comparison to our market right now, should they be considering investing maybe into international mutual funds, possibly getting some exposure for global markets as well? Is that something you would recommend to a retail investor?
Do it very cautiously because you don't know what is hitting you from where. And so when you want to invest abroad, I think most people can't understand even Indian market, so forget about and stocks like Apple also, if you see how they have fallen. So it's a tricky game. Do it if you have a good advisor and a good name. It's a good idea to take some money under the $200,000 scheme and have foreign investments if you are rich and a wealthy person. But don't forget that most of the foreign money is coming into India. So although government has allowed as a part of policy and this thing, but I'm not very sure whether this is the right time to do that. And if you do that, do it very cautiously and only select very blue-chip mutual funds, look at the track record, and be prepared there also for some loss, because the global markets are very volatile.
Alright, so finally your one word of advice for retail investors who are watching at home, or looking at their stock portfolio right now, what would that be?
Equities for long term. Don't labor too hard every day. You'll come to wrong decisions. Just invest in good stocks, forget about it. If it falls a little bit, have patience and don't panic.
Alright, so that's a wrap on this episode of All About Stocks. Nirmal, thank you so much for spending time with us. If you have questions, remember you can send it to us to the email ID that's at the bottom of your screen. Thanks for watching.